Welcome back to the Noob Selling Options channel, everyone. Today, we're tearing into a fascinating and honestly pretty dangerous situation unfolding right now with CrowdStrike. We're going to completely shut out the deafening noise of the market, ignore the hype, and just rely on pure, unadulterated math to see what's actually happening under the hood of these sky-high valuations. So if you've been feeling that intense pressure to jump into this massive run-up, this explainer is exactly what you need to hear right now, because we really need to ask ourselves, what happens when the music finally stops?
Okay, I'm going to start by throwing a question out there that probably sounds completely nuts, especially in the middle of a raging bull market where everything seems to just inexplicably go up every single day. What if 3 years of absolute, perfect, record-breaking corporate growth results in a 0% return for you, the investor? I mean, really think about that for a second. It completely goes against everything our brains tell us should happen in the market. But as we're about to see, when valuations completely detached from reality, flawless execution by a company doesn't necessarily translate into profits for the person buying the stock today. A great company, unfortunately, does not automatically equal a great stock.
And well, that brings us to this massive number, $648. That's where CrowdStrike has been aggressively tearing through its all-time highs. And look, I totally get it. We all feel it. The intense FOMO, right? That literal physical pain of sitting in cash, trying your best to stay disciplined while the stock goes on this relentless, crazy run from 500 to 600 and beyond. Honestly, it feels like watching your neighbor win the lottery every single morning while you're just sitting there meticulously balancing your checkbook. It tests absolutely every ounce of your resolve. You start thinking, am I the idiot for sitting on the sidelines? It's an incredibly heavy psychological weight to carry.
To understand why this happens to us, we need to look at why insisting on strict valuation metrics feels like you're fighting basic human biology. When stocks are sitting at all-time highs, our psychology creates this overwhelming urge to just abandon ship on our rules. And Wall Street, they feed this frenzy. They declare a new era to justify completely absurd prices, weaponizing your FOMO and triggering this recency bias where we actually start to normalize the absurd. Suddenly, you're hit with action bias. You feel this unnatural, burning urge to just do something, anything, because doing nothing feels so wrong. That leads right into the greater fool rationalization, where you buy an overvalued stock just crossing your fingers that someone else will pay even more for it next week. And all of this is compounded by loss aversion. Holding cash while the market is surging makes you feel like your cash is just melting away. The emotional strain of sitting still is huge. So to survive an all-time high market and keep your capital intact, we have to make a major mindset shift. Take the speculator mindset, for example. They're completely obsessed with short-term price action, like, where's the stock going tomorrow? They are driven almost entirely by FOMO, and they view holding cash as a completely wasted opportunity. Now flip that and look at the operator mindset. An operator acts like a ruthless insurance underwriter. They focus exclusively on deep value and hard math. They are driven by the fear of overpaying and permanently destroying their hard-earned capital. To the operator, cash is definitely not trash. It is a strategic asset. It's an option to deploy when future volatility inevitably strikes. We absolutely need to lock in this operator mindset today. Right, let's dive into the mechanics of this. To be true operators, we need a solid mathematical anchor. And when it comes to high-growth tech, that anchor is the PEG ratio. The price-to-earnings-to-growth ratio is just an incredibly disciplined valuation metric. Simply put, setting a PEG of exactly 1.0 means you are only willing to pay a forward PE multiple that perfectly matches the company's projected earnings growth rate. So why is 1.0 the magic number here? Well, because anything over 1.0 means you're paying a massive premium for growth that hasn't even happened yet, leaving you totally vulnerable to sudden market corrections. The psychology of insisting on a PEG ratio of 1 is absolutely crucial for us. It's what forces us to keep our heads firmly on the ground while the rest of the market is just floating away on a cloud of hot air. Let's apply this anchor to CrowdStrike. Wall Street consensus forecasts estimate that CrowdStrike's earnings per share will scale significantly over the next 3 years. Their projected annualized growth rate is a massive 39.9%. Actually, let's just pause for a second to appreciate how incredibly difficult it is for any company to compound earnings at nearly 40% annualized over 3 straight years. It requires absolute operational perfection. But remember our rule. A PEG of 1.0 means the PE multiple should perfectly match the growth rate. Therefore, our strict target valuation multiple for CrowdStrike drops to a flat 39.9x PE, not the 80x, 90x, or 100x that the market is so eagerly demanding today. Okay, let's run through the cold hard math of our valuation for a PEG ratio of 1. We're looking at 2 structural timelines here. Scenario A is based on near-term estimates, and Scenario B rolls over to capture the next wave of compounding. To buy CrowdStrike at a PEG of 1 today, the stock would have to pull back drastically.
In scenario A, your required entry price is around $235. In scenario B, it's about $300. For our viewers using the option wheel strategy, this means you're aiming your cash-secured puts way down at these $235 to $300 structural support levels. That's exactly how you establish a true intrinsic safety net and a massive margin of safety. Now look closely at the projected outcomes. If CrowdStrike successfully compounds its earnings at nearly 40% for 3 straight years, and we apply our disciplined 39.9x multiple, the future estimated price for scenario B is an impressive $894. But take a very close look at the estimated price in 3 years for scenario A. It's $639.60.
And here is where the brutal reality check hits us right in the face. Compare CrowdStrike's actual price today, hovering around $648, to our mathematically sound 3-year future price of $639.60. Do you see the trap here? The market has effectively dragged forward the next 3 years of absolutely flawless execution and completely priced it in today. Think about what that really means for you. If the business triples its earnings over the next 3 years, doing everything perfectly, but the broader market simply decides to normalize the valuation back to a fair PEG ratio of 1, the stock price will end up completely flat. Actually, slightly negative. You will have held the stock for 3 full years, taking on all that massive risk for a grand total of 0% return.
So the absolutely crucial point here is understanding the hidden structural risks you are taking on by chasing the stock at $648 right now. First off, you are actively betting on zero multiple compression. You're gambling that in 3 full years, the market will still be euphoric enough to pay a wildly inflated premium for the stock. Second, and this is huge, perfection is mandatory. The company can't just meet Wall Street's aggressive growth targets. They have to completely shatter them. There is zero margin for error here. A single bad quarter, a slight miss on guidance, or even just a broader macroeconomic slowdown, and that premium multiple just collapses. And finally, your margin of safety, it's completely gone. The risk-to-reward ratio is entirely skewed against you right now because multiple expansion has run way, way ahead of fundamental earnings growth. When you take a step back and really truly look at the math, you realize that refusing to chase the herd isn't just about being conservative, it's about keeping your capital intact. And it brings us to this absolutely essential truth for the operator. No trade is always better than a bad trade. True edge in the financial markets belongs to the disciplined few. It belongs to those who can ignore the noise, ignore the FOMO, sit quietly on their hands, and wait patiently until the math completely and undeniably aligns in their favor.
Thank you so much for walking through this mathematical reality check with me today. Keep your head grounded, stick to your structural valuations, and please don't let the euphoria of a bull market trick you into giving up your operator edge. If you found this explainer helpful and you want to keep making smart, disciplined, math-based decisions with us, please hit that like button and subscribe to the Noob Selling Options channel. We've got a lot more deep dives coming your way soon. So before you hit buy on the hottest stock in the market tomorrow morning, ask yourself this one question. Are you investing as a disciplined operator, or are you just the latest victim of the $64 trap? Think about it. Stay disciplined out there.